Welcome everybody to Chapter 2. Before we get started, does anyone have any questions regarding anything from Chapter 1 before we continue on to Chapter 2 this week? Anybody? Can you hear me? Can you hear me?
Yes, we can hear you.
Yes.
Great. So do you see my screen?
Yep.
Great. Okay, so I am recording this and we are going to start with Chapter 2 today. Now, guys, I want you, as I'm going through this chapter, if there's anything that's you question or anything you're not clear on, please stop me and ask me questions. That's how I want this time to go, because if you're having a question, chances are other people are too. So last week we went through a lot of the basics, the beginning of accounting. What does financial accounting really set out to unfold, to complete? And what we're going to do this week is really get into the nuts and bolts of how we do measure various financial transactions or company transactions. We're going to call this the accounting cycle. We're going to start with the first half of the accounting cycle this week and then finish it for next week. So we learned from Chapter 1 that the two functions of financial accounting is to measure business activities of the company. We measure them by deciding what categories do these go in. And we're going to learn this week how to record transactions. Once all those transactions are recorded, those transactions are put together into financial statements that then communicate those various measurements to external parties. We communicate it by preparing financial statements. So how do we measure transactions? What we are going to do is we will find source documents, and we'll go through this, that identify the accounts that are going to be affected by these transactions companies have with external users. Then we're going to look at this transaction and see how it impacts the accounting equation. We're going to learn something new called a debit and a credit. Then we're going to record these transactions in a journal. We're going to post them to the general ledger, and we're going to look at preparing what's called a trial balance. So we've got a lot to cover this week. And again, if you have any questions, you ask. So we're going to, I said, find some source documents that identify what's being affected. See how these transactions fit into the accounting equation. We're going to decide if we're going to use what's called a debit or a credit. We're going to record the transactions.
I have a quick question. I was wondering, so is part 1 today, and this is a part of Chapter 2, is the other part B, is that going to be Chapter 2 as well?
No.
Into next week, or is that Chapter 3?
Correct. So the accounting cycle is in 2 chapters. It's in Chapter 2 and Chapter 3.
Okay.
So the first portion of the accounting cycle we'll cover this week. And then next week, we'll cover the second portion of the accounting cycle. Okay. So basically, we're going through the process of getting the documents, analyzing how it fits into the accounting equation, learning about debits and credits, We're going to record the transaction, post it to an account, and we're going to prepare a trial balance. We got a lot to learn today. So we learned last week that an account is a summary of all the transactions related to a particular item over a period of time. Now, we talked last week that a category can be called an asset. And in that category, we can have various accounts, such as cash, supplies, equipment, buildings. Remember that, investments in other companies. They're all accounts with the category, the big heading, assets, or the category liabilities. Can show various accounts such as accounts payable, salaries payable, utilities payable, taxes payable. Then we have these stockholder equity accounts, common stock and retained earnings. Now, all these various accounts are contained in what we call a chart of accounts. A chart of accounts is a list of all account names used to record transactions. Now, I must tell you, each company will have a unique chart of accounts. Of course, all companies are going to have cash. Of course, they'll have that in revenues. But when it is related to manufacturing companies, they're going to have various types of inventory accounts. Whereas a company that just is a service company might not have inventory accounts. So as we're learning here, this 6-step measurement process we saw earlier is going to be the core here of financial accounting. So we're going to take various transactions and work with them so you can see how this happens. Each transaction is going to affect the accounting equation. Each transaction will have what we call a dual effect on the accounting equation here. We know that if assets increase in a transaction, then liabilities or stockholders' equity also must increase by the same amount. Or if total assets decrease, then we know that liabilities or stockholders' equity will also decrease by that same amount. So as we start this, we're going to say, hey, what's one account that's affected by the transaction? And this account, is it going to increase or decrease? And then we'll say, well, there's got to be another account that's being affected. What's happening to that account? Is it increasing or decreasing? And finally, we know at the end of every transaction, our assets must always equal our liabilities plus our stockholders' equity. So guys, we're going to take these transactions for Eagle Soccer Academy, and we're going to pick them apart and understand this process. So the first transaction is they sold shares of common stock for $200,000 to obtain the funds necessary to start the business. So when they sold common stock and received $200,000, can you guys think of one possible account that was affected?
Assets.
Assets. Assets is the category, but what specific account in assets could have been affected?
Would it be cash or cash in bank?
Cash. Perfect. When we received 200,000, that's cash, isn't it? And what happened to cash? Did our cash increase or did it decrease?
Increase.
It increased by 200,000. So guys, this transaction, we sold common shares of stock for 200,000. We know one account that was affected is cash and it increased. So guys, can you think of another account that was affected by this transaction?
Common stock.
Yes, common stock was affected by this transaction and it also increased by $200,000. So we have a transaction, we've processed it and decided, okay, what we're going to do, in class, the IRS was closed. What we're going to do is we're analyzing the various two accounts. How does it affect the accounting equation? Our assets, which is cash, increased 200,000. And our stockholders' equity section also through common stock increased 200,000. At the end of this transaction, do our assets still equal our liabilities plus our stockholders' equity? Yes. Don't they? Assets are 200,000, they increased, but our stockholders' equity also increased by 200,000. Sometimes one might think we decrease cash of a way of recording an investor's initial investment. But remember, we are preparing the books for the company, not for the individual that invested in the company. So the individual that invested in the company, his cash went down 200,000, but the company's cash increased 200,000. Does that make sense? Here's another transaction. We borrowed cash from the bank. So the company borrowed $100,000 from the local bank and signed a note promising to pay the full amount back in 3 years. Okay. When you think of this transaction, what do you think happened?
Increase in cash.
Yeah.
Increase in liabilities.
An increase in cash and an increase in liabilities. That's exactly right. So our assets increased 100,000 and our liabilities increased 100,000. Okay. So at the end of, after we've posted this transaction, are our assets still equaling our liabilities plus stockholders' equity? Yes, our assets went up 100,000, but our liabilities also went up 100,000. Okay. Now, after these two transactions, we see our assets are 300,000 and our liabilities plus our stockholders' equity are also 300,000. After each transaction, the accounting equation must always remain in balance. In other words, assets must always equal liabilities plus stockholders' equity. Here's another one. We purchased equipment necessary for giving soccer training, $120,000 cash. So when we purchase equipment using $120,000 cash, what can you tell me something that happened in this transaction?
Increase in equipment.
Increase in equipment of $120,000. And what else happened?
A
Decrease
decrease
in
in cash.
Excellent. An increase in equipment, a decrease in cash. So guys, this particular transaction only affected assets. One went up 120,000. One asset went down 120,000. But do we still balance? Do our assets still equal our liabilities plus our stockholders' equity?
Yes.
Good. So at the end of this transaction, our assets are 300,000 and our liabilities plus our stockholders' equity are also 300,000. Sometimes it's tempting to decrease cash as a way of recording an investor's initial. Oh, gosh, I swear I already showed that. Okay, I must have, and I just put it in here twice. Sorry, guys. Here's a question for you. What would be the effect on total assets if a company purchased land for 200,000 cash? Think about it. Just like what we had, land goes up 200,000, cash goes down 200,000, but do our assets remain the same?
Yes.
They remain the same.
They remain the same. Someone needs to mute their, Aubriana, I think you need to mute your speaker. So they remain the same because the transaction only affects assets. One goes up, one goes down, but ultimately it's the same. After each transaction, the accounting equation must always remain in balance. Assets must always equal liabilities plus stockholders' equity. Remember that, guys. Check it out every time. Okay, guys, this is something new we're going to talk about. This is about paying rent in advance. They paid 1 year of rent in advance. They paid $60,000 for their rent, which is $5,000 a month. Now, guys, this is a new asset we're going to talk about. It's called prepaid rent. Prepaid rent is an asset because we are paying for the use of a building for a year in advance. As each month goes by, it becomes an expense. But the initial purchasing rent in advance is an asset. So in this case, we pay $60,000 in cash, which reduces our cash. But our prepaid rent account, which is an asset, increases by $60,000. So when we're done here, guys, our assets are still $300,000. Our liabilities and our stockholders' equity are also still $300,000. Okay?
Is it possible you could explain why it would become an asset instead of a liability once, or not, well, if they spent it,
So a
I guess how
liability
it-
is a future sacrifice. An asset has a future benefit. So the reason this prepaid rent is a future benefit is we're paying now for the benefit of renting this building for a year, for 12 months. It becomes an expense when we've used it up. But you see, we haven't used it up yet. We still have the benefit of renting this for 12 months. That's why it's an asset. An asset is a resource the company has that provides a future benefit. So just like prepaid rent is an asset because it's going to provide us with rent, equipment is also an asset because it's providing us with a future benefit, the benefit to utilize this equipment in order to do our job.
that
Cash.
makes sense.
Yeah. And guys, that's what's helpful. So Jenna, when you ask me questions like that, what it does is it just makes me say it another way, which can click to you guys. We all learn in different ways, guys. So sometimes I say something and it just might be blank to you. But then if you ask me to say it another way, it might click with you. Does that make sense, what I'm telling you? The reason this is not a liability is we don't owe anybody anything, right? We've paid for it. We're going to have a benefit in the future. Okay, now we purchase supplies on account for $23,000. Again, supplies go up, and oh, but here's the other thing. Did we use cash? No. We purchased them on account, which means we owe somebody money. That's called an accounts payable. Someone provided us with these supplies, but we have usually 30 days to pay it. It's a liability because we owe them money, don't we? So in this situation, our assets increased by 23,000, but didn't our liabilities increase also by 23,000? So when we're done with this particular transaction, our assets are 323,000. Our liabilities plus our stockholders' equity are also 323,000. Okay, I just wanted to make sure I wasn't missing anybody. Now, we're just going to just add another dynamic to this equation. Do you remember last week when we were talking about retained earnings? We said that retained earnings showed the beginning balance. We added net income and we subtracted dividends to come up with our retained earnings. Well, what does net income entail? Net income really is a result of revenues minus expenses. So we know whenever we have revenues, that increases our retained earnings. And whenever we have expenses, that decreases our retained earnings along with dividends. So we're expanding this equation because, as we're aware, we add our net income to retained earnings. But since we're now working on transactions, we need to understand that revenues increase our retained earnings, expenses decrease our retained earnings, but it's the same effect as net income. Revenues minus expenses equal our net income. So this expanded accounting equation shows revenues increase retained earnings, our expenses and our dividends will decrease retained earnings. And we know that retained earning makes up the stockholders' equity section, with the combination of common stock being one facet and retained earnings being the other facet. Now, this next one, I'm going to have you guys help me. We provide soccer training to customers for cash for $43,000. What happens here, guys? Cash increases. But what else is increasing, guys? Service revenue is increasing, isn't it? Service revenue is a part of retained earnings. So at the end of this transaction, our assets equal $366,000. Our liabilities plus our stockholders' equity also equal $366,000. Then when we provide soccer training to customers on account, okay, guys, this is new. Soccer training to customers on account mean that they didn't pay us cash right away. They owe us the money. Now, when we owe someone money, it's a liability. But this one is what's called an accounts receivable. The company is due the money from a client. That is an accounts receivable. Think of it as if he gave us cash, we would have the cash, but it's on account, which means we haven't received the cash yet. We're due the cash. Accounts receivable is a resource because when this account becomes satisfied, it provides us with cash. In this case, our assets have increased 20,000 and our liabilities plus our stockholders' equity, the service revenue, has also increased by 20,000. Okay. So next, this is a unique item. And I told you guys last week that every liability has the word payable after it, except one that we're going to talk about right now. We received cash in advance for 12 soccer training sessions to be given in the future for $6,000. Now let's think about this. We're getting cash today for something we have to provide in the future. This is why we call it a deferred revenue. We're getting the cash, but we have not yet performed the service. We need to provide the service in the future. So it's basically a future sacrifice. We owe them something. We don't owe them money. We owe them a service, 12 soccer lessons. So this is the only liability you're going to see that doesn't say payable. It says deferred revenue. Okay. Do our assets still equal our liabilities plus our stockholders' equity? They do, don't they? Don't let the name fool you. even though the term revenue appears in the account title for deferred revenue, this is not a revenue account. Deferred indicates the company has yet to provide services, even though it's collected the customer's cash. Company owes the customer a service, which is what creates the liability. Now we pay salaries to employees for $28,000. Can anyone tell me an account that's going to be decreased? Anyone?
Would it be either salaries payable or cash, depending on how you pay them?
So correct. So cash decreases because we're paying salaries. You're right. Depending how we pay them, if we haven't paid it yet, then it increases a liability. But in this case, let's assume we pay salaries to employees with cash. So cash goes down 28,000. And also our stockholders' equity is going to go down 28,000 because an expense reduces stockholders' equity. Okay, but do we still balance? Yes. Our assets of 364,000 still equal our liabilities plus our stockholders' equity. I just want to stick in another zero here. I saw that was missing. Okay. Sorry about that. Okay. So we're still balanced. Now we're going to pay cash dividends of $4,000 to stockholders. What's one thing that's going to decrease, guys? There's two items that are going to decrease here. What's one?
Cash.
Retained
Cash
retained earnings.
and retained earnings through dividends. So cash goes down 4,000 and our retained earnings via dividends goes down 4,000. But guys, do you see we're still balancing? Our assets of 360 still equal our liabilities plus our stockholders' equity. Students often believe a payment of dividends to owners increases stockholders' equity. But remember, we are operating on behalf of the company, and we are giving a portion of our income, our profits, to those who own the company, the stockholders. So when we pay dividends, we are reducing our cash and we're also reducing our retained earnings, stockholders' equity. So after all of these transactions, we show exactly what was affected by each transaction. But after each one of these 10 transactions, our assets still equal our liabilities plus our stockholders' equity. So guys, what effect does the payment of dividends have on the accounting equation?
Is it B, assets decrease and equity decreases?
You're exactly right. Our cash decreased, which is an asset, and our equity decreased because dividends reduced retained earnings, which is part of stockholders' equity. And guys, what effect does the payment of dividends have? Well, didn't I just say that? Yeah. Okay. We did it again. I have that in there twice. I'm going to just real quick, since it's in here twice, delete this slide. No, maybe. Maybe I just, okay, I don't know what I did there. I'm sorry. Yeah, I do have it in there twice. I apologize, guys. I had to create new slides this semester, so that's why it's a little goofy here. Now we're going to come to terms, debits and credits. Now, guys, I'm going to tell you something. This can confuse a lot of people, but it really doesn't need to. Debit just means left. That's all it means is left. Credit just means right. So when you look at this slide, debit means it's on the left side. Credit means it's on the right side. That's it. Debit is left, credit is right. Okay? Period. But certain accounts increase with debits, certain accounts increase with credits, and certain accounts decrease with debits, certain accounts decrease with credits. One thing I want to tell you real quick. People get confused because they think when you credit an account, it increases an account because you go to the bank and you deposit money in your bank and they say, oh, we credited your account. You know what I'm talking about? But your account for the bank is a liability. If you're doing the books for the bank and you deposit money into their account, their cash increases and your bank account, which is a liability for them, increases. That's why they say we're crediting your account. Know this. Make a sheet that you keep near you that shows debits and credits. In the accounting equation, assets are on the left side of the accounting equation. Assets equal liabilities plus stockholders' equity. Assets increase with a debit and they decrease with a credit. It's just left and right. Liabilities are on the right-hand side of the equation. So they increase with a credit, as do stockholders' equity, and they decrease with a debit. Remember, debits mean left, credits mean right. Since assets are on the left side of the equation, they increase with debits, they decrease with credits. Since liabilities and stockholders' equity are on the right side of the equation, they increase with credits and decrease with debits. As we expand this, since retained earnings increases with credits, then that means our revenues are going to have a normal credit balance because it increases our retained earnings. But since expenses and dividends decrease our retained earnings, then we know their normal balances are going to be debit balances, which means they increase with debits and they decrease with credits. This slide right here would be really important for you guys to print out and to have beside you whenever we're working on transactions. This is a great aid. You take the word dealer. DEA stays on the left-hand side or the debit side, and those have normal debit balances. Dividends, expenses, and assets have normal debit balances, which means they increase when you debit them and they decrease when you credit them. LOR, liabilities, stock owners or owner's equity, and revenues have normal credit balances, which means they increase with a credit and they decrease with a debit. This is another great slide to keep near you. What does the word left mean? Oh, excuse me. Yeah, I gave you the answer. What does the word debit mean? Left. Always don't think of debit as increase. For some accounts, it increases, and for others, it decreases. Debit means left. Now what we're going to learn is how to record these transactions in a journal entry using debits and credits. All a journal is a chronological record of transactions, and we use the format called a journal entry, which means we record first the account that we are going to debit, and then we will indent the account that we are going to credit, the account or accounts we are going to credit with a description. Remember, we always have to have the same amount on the debit side as we have on the credit side. So on December 1st, when Eagle Soccer Academy sells shares of common stock to investors for cash of $200,000, we know cash was debited because it was increased, and because cash is an asset, we debit it to increase it. We debit our cash for $200,000, and we're going to credit our common stock for $200,000. Why? Cash is on the left-hand side of the accounting equation as an asset. To increase it, we debit it. Common stock is part of stockholders' equity. It's on the right-hand side of the accounting equation. And to increase common stock, we credit it. Again, our assets equal liabilities plus stockholders' equity. We still balance. Many students forget to indent the credit account names. For the account credited, be sure to indent both the account name and make sure you put the amount on the credit side, which would be indented to the right. What does it mean to post transactions to the various accounts? All it means is just transferring the information in each journal, cash, 200,000 debit, to the various transactions. So to post just means taking the cash in the journal for 200,000 and transferring it to the cash account showing December 1st, the description: issue common stock for cash, 200,000. And then we do the same for common stock. We find the account common stock and we credit the 200,000 here. So our ending cash balance is 200,000 up here. Our ending common stock balance is 200,000. We know that cash has a normal debit balance. To increase it, we debit. To decrease it, we'll credit it. But common stock is the exact opposite. To increase this, we credit it. And to decrease it, we debit it. On December 1st, Eagle borrows cash from a bank for 100,000. We show cash increases 100,000, and our notes payable, which is a liability, also increases 100,000. we go to the cash account and we post that 100,000 as a debit to the cash account. We go to the notes payable account and we credit this to the account to show a balance of 100,000. Okay. A T account includes the account title at the top, one side for recording debits and one side for recording credits. The left side of the T account is the debit column. The right side is the credit column. Here are the T accounts for cash and notes payable after posting the transaction. On December 1st, Eagle purchases equipment with cash for $120,000. We're going to debit our equipment and we're going to credit cash. Now, we can also use, instead of taking each account, we can use accounts in what we call a T account version, which is just a simplified version of various independent accounts, where we just stick them on the left side or the right side like this. So in posting this, in posting it to equipment, we debit the 120. And then in cash, we credit the 120. Remember, when we credit cash, it's going to reduce our cash balance. On December 1st, Eagle pays 1 year of rent in advance, $60,000, which is $5,000 per month. We debit our prepaid rent for $60,000. We credit our cash for $60,000. We show a debit to the account prepaid rent. We show a credit to our cash for $60,000. On December 6th, Eagle purchases supplies on account. We would show supplies of $23,000 and a credit to accounts payable of $23,000. Here we debit our supplies and we credit our accounts payable. On December 12th, Eagle provides soccer training to customers for cash, $43,000. Here we debit our cash for $43,000. We credit our service revenue for $43,000. Here on December 17th, Eagle provides soccer training to customers on account for $20,000. Here we debit our accounts receivable, which is an asset, for $20,000, and we credit our service revenue for $20,000. Again, on December 23rd, Eagle receives cash in advance for 12 soccer training sessions to be given in the future for $6,000. Here we debit our cash for $6,000, and we credit our deferred revenue for $6,000. On December 28th, Eagle pays salaries to employees for $28,000. Here we debit our expense for $28,000. We credit our cash for $28,000. Then when Eagle pays cash dividends to shareholders for $4,000, it's here we debit our dividends and we credit our cash for $4,000. You see how we're running? We're keeping a running total on our accounts. So once all this is said and done, here is the summary of all the various journal entries we've done. And here are the balances of all the accounts. Now we show the asset accounts, the cash, the accounts receivable, the supplies, the prepaid rent, and the equipment. We show the liabilities, and we show your stockholders' equity. Which of the following is used to provide a chronological record for all transactions affecting a firm?
B.
Okay, 1 second here. Okay, the journal. And which of the following accounts would be debited when a company pays $12,000 in advance for 1 year of rent? What do you guys think?
C.
C is perfect. Okay. Okie doke. Now, the next step after we've prepared all our various transactions and analyzed them, and now we know the new balances, we will now create what we call a trial balance. The trial balance is purely a list of all accounts and their balances on a specific date. The total debits will equal the total credits. The trial balance is only used for internal purposes, and it's just a way in which we make sure our debits equal our credits. So you'll see here that our assets equal our debits equal our credits. Our debits are listed in the debit column, the accounts that have normal debit balances. The accounts that have normal credit balances are listed in the credit column. They must always equal. So which of the following accounts would appear in the credit column of a trial balance? Hmm? Which of the following would have a credit balance? Wouldn't it be common stock? Would have a normal credit balance. So what I'd like to do, guys, is I want to go through some homework with you so it can kind of click, okay? So let's look at some homework here. Let's look at this first. I'm going to set it up as a student view here so we can work on them together. Let's look at these and let's try to work together to see if we're kind of figuring out how this occurs. I want you to give yourself about 5 minutes and try this, and then I'm going to come back on and we're going to go through it, okay? So give yourself a couple minutes here. I'll be right back. Hey, guys, do you need some more time or would you like me to work with you? Would you like more time? Ready, ready, ready. Okay, so we'll start. And if you don't understand, please, pipe in. So guys, when we purchase business supplies on account, what are the accounts that are affected? It's supplies would be debited, accounts payable would be credited. So our supplies is an asset, it would increase. Our accounts payable is a liability and it would also increase. Now you can go over here and check your work to make sure we did it correct. Okay. Pay for legal services for the current month. When we pay for legal services, that means we use cash. So our asset cash would be decreased. And wouldn't our stockholders' equity, because of rent expense, also be decreased? Again, you can check your work to make sure you're following in line.
Did you say rent expense?
Sorry, legal expense. I'm so sorry. Legal expense, pay for legal services for the current month, legal expense. I'm sorry. Who wants to take number 4? Does anyone want to take number 4? Do you want me to do it? I'll do it. Provide services to customers on account. Okay, that doesn't mean we received the cash yet. That means they owe us the money, which is an asset. Accounts receivable means we are to receive the money. So accounts receivable will be an increase. When we provide services to customers on account, that means revenue increases. Our service revenue will also increase. Okay. When we pay employee salaries in the current month to accounts, salaries expense is the debit, cash is the credit. Cash decreases because we're using it. Salaries expense will decrease stockholders' equity because any expense reduces stockholders' equity. When we provide services to customers for cash, our cash increases and our service revenue increases, which increases our stockholders' equity. You can continue to check your work just to make sure everything is in line. When we pay for advertising for the current month, won't it just be like number 3?
Yes.
Yeah, it's going to be just like an expense and we pay for it. So our cash is going to decrease and our retained earnings through stockholders' equity will also decrease because expenses decrease stockholders' equity. Now, let's look at 8. We repay a loan from the bank. when we repay a loan, what is it we use to repay money?
Cash.
Cash. Cash gets decreased. When we have a loan, it's a liability. When we pay off the loan, doesn't it decrease that liability?
Yes.
When we pay dividends to stockholders, won't that also be like number 3 and number 5, except it's not an expense, it's a dividend, but won't it still reduce stockholders' equity?
Yes.
So we decrease our cash and we decrease our stockholders' equity. When we receive cash from customers in number 4 above, I want you to think about it. What happens when someone owes us money? It's an accounts receivable, and they pay it.
Doesn't the cash increase and the liability go down, or
It's not a liability, though. It's
because
an
it,
accounts
okay,
receivable, and it's an asset.
okay.
So do you see, guys? Nothing's going to change. The assets are going to stay the same because cash goes up and accounts receivable goes down. So technically, nothing's going to change there, is it? It's not going to affect our assets. It's not going to affect our liabilities or stockholders' equity because the only 2 accounts we're dealing with is cash and accounts receivable. They're both assets. Cash will go up, but accounts receivable will go down, and there's no change. Okay. Last, pay for supplies purchased in 1 above. Excuse me, in 2 above. We paid for our supplies on account. What are the 2 accounts we're dealing with?
Assets and liabilities.
Yes, cash and accounts payable, right? So our cash when we pay a bill goes down. But now won't our liability also go down because we paid it? Doesn't that make sense?
Yes.
Yes, it does.
Am I required to put anything in here? I don't think I need to put anything in here because it doesn't do anything. So it looks like,
On our end, we can see that it says answer is complete and correct.
perfect. Got it. So we're good to go. Guys, no, in number 10, you don't need to do anything there, okay? Okay. Does this make sense? Can we move on, or would you like me to go over any of these?
Could you go over why number 10 is the way it is again?
Absolutely. So, number 10, it's related to number 4. Number 4 says, provide services to customers on account. Okay, so when we provided services to customers on account, what we did there is we debited something called accounts receivable, and we credited service revenue. Okay, so we debited accounts receivable, we credited service revenue. Now it says the customer paid for the service. So we don't deal with service revenue anymore. We showed that back when we provided the service. So in number 10, we received the cash from the customer. Here, let me do it this way, guys. Sometimes it's easier just to show it to you this way. We have when we provided services, we debited accounts receivable for 10,000 and we credited sales revenue for 10,000. Okay. This is an asset. This is a revenue account which affects stockholders' equity, increases stockholders' equity. It says the customer paid their bill. So we're going to debit cash of 10,000 and we're now going to credit accounts receivable because they don't owe us that money anymore. They just gave it to us. Cash is an asset. Accounts receivable is an asset. Did our assets change? No. One went up, one went down. But the assets remain unchanged ultimately. Does that make sense?
Yes, it does. Thank you.
You bet. Okay. Let's look at this one. Now, guys, I don't want to put you on the spot, but do you like me just going through it, or do you like taking some time to try to do it yourself?
I do like taking time to try to do it for ourselves first.
Let's do that. I'm going to give you a couple
Agreed.
minutes here, guys. You guys ready? Okay. So when we pay $400 for the current month's rent, let's think of the two accounts that we'll be using here. What is the account we're going to debit? That's an expense. Won't it be rent expense? Rent expense, and then we reduce our cash, so we credit cash. So our asset will go down $400, and our stockholders' equity will also go down $400 because expenses reduce stockholders' equity. Okay? Now, guys, I'm going to tell you right now, number 3 is kind of tricky. Hire a new employee that will be paid $500 at the end of each month. Was that truly a business transaction that we record? It was a business transaction in that they hired an employee, but are we ready to pay the employee yet? No. When it says pay the employee, that's one thing. All they did here was hire the employee. Now, if it said hired the employee and gave them a $5,000 starting bonus, that would be different. But it just said hired employee, and this is how much they will be paid. So that nothing's going to happen there. Pay $100 for advertising aired in the current period. The reason they said current period is that makes it an expense. If they said paid $200 for advertising for this year, that would be different. That would become a prepaid advertising asset. When we purchase office supplies for $400 cash, what happens? Supplies go up $400 and cash goes down $400. Make sure when you do that, do you see how they gave you 2 spaces here? You want to show one went up and one went down. Okay. How's everyone doing?
Good.
Okay. When we receive cash of $1,000 from customers in one above, remember we provided services to customers on account, which means we would have debited accounts receivable and credited the sales revenue. If we received $1,000, then we will debit $1,000 cash, and we will credit $1,000 of accounts receivable. Now they haven't paid us all of it. Minus, oh, come on. So they haven't paid us all of it, but since they paid us $1,000, we increase $1,000 cash, decrease $1,000 accounts receivable. That means the account receivable balance is $600. Number 7, we obtain a loan from the bank for $7,000. When we obtain a loan, we receive cash of $7,000, and now our loan or note payable also increases $7,000. When we receive a bill for $200 for utility costs in the current period, what are we going to do there? We haven't paid the bill, we just received the bill. So that means our accounts payable is, our utility expense is going to be debited 200,000, and we'll credit accounts payable for 200,000. Oops, I should have subtracted that because that reduces our stockholders' equity having an expense. When we issue common stock for $10,000 cash, that means our cash was increased $10,000 and our stockholders' equity was also increased $10,000. When we finally paid $500 to the employee in number 3 above, when we pay a salary, we debit our salary expense and we credit cash. So when we credit cash, it goes down 500 and our salaries expense also reduces stockholders' equity by 500. Do they want us to put all the totals in here? I don't think so. Answer is not complete. I guess they want us to show all of these. So 12, 11, 15, 11, 21, 11, 100, 8,700, 18,700, 18,200. Is that what they're wanting us to do? I got the number wrong here. 1,200, 1,100, 15, 11, 11, 8,100. Okay. 18,100, 17,600. So guys, you'll want to do the same. The key here is that the assets still equal your liabilities plus your stockholders' equity. So you're going to want this number to be 7,200 and this number should be 12, 11, 11,000, 10, 10,400. They're just wanting to, again, everything's got to equal there. Any questions with that? Here, guys, you should know if it says payable, it's a liability, unless it's prepaid or deferred revenue, it's a liability. So they want you to know the account, type of account, and if the normal balance is a debit or credit. Remember, assets equal liabilities plus stockholders' equity. Assets are on the left-hand side of this equation, so that is a normal debit balance. Since liabilities and stockholders' equity are on the right-hand side of the equation, that's a normal credit balance.
Quick
Assets.
question.
What?
You said payable equals liability except for prepaid and deferred revenue, right?
Deferred revenue, not prepaids, I'm sorry, are assets. Remember
Gotcha.
the term called deferred revenue that doesn't say payable, but is still a liability? So assets, guys, let's think of some assets. Cash, accounts receivable, buildings, equipment, supplies, prepaid rent, prepaid anything. Those are assets. Liabilities have the word payable after them, except the word deferred revenue. Stockholders' equity is going to be common stock, retained earnings. Now we know retained earnings is made up of revenues and expenses. Revenues increase retained earnings, therefore they have a credit balance. Expenses decrease retained earnings, therefore they have a debit balance.
Would you write minus dividends there or no?
Yes, ma'am. Yes, yes, yes. Thank you. Dividends also have a normal debit balance, and they would also reduce retained earnings. Thank you so much. So when you go to do this problem, the first thing you need to do is figure out what type of account is it. And then once you know the account, you know the normal balance. Assets have a normal debit balance. Liabilities and stockholders have normal credit balance. Revenues have a normal credit balance. And expenses have what? A normal debit balance. Does that make sense? Next. I am going to give you the answers to this one and the next one. The key here, guys, is with this one, Jake owns a lawn maintenance company and Luke owns a machine shop. The requirement is record the transactions for Jake's lawn company. Then number 5 is going to be record them for Luke. Make sure you know who you're recording them for. I'll give you those answers. And then again, you'll show how the various journal entries affected the accounts. Now, this number 7 is to prepare a trial balance. Now, I want you to know a trial balance mainly consists of showing the accounts, usually, and I don't think they're going to require you to do it here, but usually you start with assets, and then you do liabilities, then you do stockholders' equity, then you do revenues, and then you do expenses. So you can see this first grouping of accounts, cash, accounts receivable, supplies, prepaid rent, and equipment, which they don't give you the amount, have all what kind of balances, guys? Debit balances. All of the liabilities, the payables and the deferred revenue, have credit balances. The common stock and the retained earning have credit balances. The revenue has a credit balance, but dividends and expenses have a debit balance. So if you put all these in, and even though they don't tell you the balance of equipment, you can figure it out because debits must equal credits. So as long as you have all your credits in here correctly, you'll know what the debit balance needs to be and you can plug in your equipment. Does that make sense? So for example, cash, accounts receivable, Okay, they want me to do a numeric right now. So our cash is sitting here at 40,000. Our accounts receivable is at 50. Our supplies are sitting at 1,100. Our prepaid rent is sitting at 3,000. The equipment, we don't know yet. Then we've got accounts payable. That is a credit balance over here of 17,000. Our salaries payable should be a balance of 5. Our interest payable is 3. Our deferred revenue is 9. Our notes payable is 30. Common stock has what kind of balance? A credit balance. Retained earnings has a credit balance. Then we've got dividends of 1,100, which has a debit balance. We've got service revenue of 65,000. We've got salaries expense, rent expense, interest expense. Supplies expense, utilities expense. Excuse me, expenses have debit balances. Seven, 3, 12, and 30. Guys, do you see here if our credits are at 214? What does our equipment need to be to get to 214? $46, 8, 56, 60,800. Check your work. The key to this is you need to know what's a debit and what's a credit, don't you? Next, this is a tough one. This one, you have to record these transactions. So, for example, when it says pay rent for mountain lodges for the month of December, 900, then you have to go, okay, what's my debit and what's my credit? So if you pay, it's usually a credit to cash. and rent would generally be a rent expense. So you could click on this and find your different accounts. Usually you should see a rent expense here. And then you would be crediting cash for, how much was it, 500? Excuse me, $900. So you are going to put in your transactions and you can check your work. Remember to check your work. You can have it figured out right. You're going to put in all of these various transactions. Okay. Issue additional shares, pay employees. They should be pretty straightforward. Then I believe the T accounts, you will transfer your figures over to those T accounts, and then you'll create your trial balance. So that's going to be an all-inclusive problem, but very helpful for you. And then last, we've got one like it. So, or is that the one we just did? Oh, no, this is the same one. They record each of these transactions, and then you're putting it into your general ledger and ultimately getting your cash. I think a lot of this will carry over for you. So anyway, you will, that's going to be, this can be a challenging chapter, but very beneficial for you. The next thing I want to go over is your Chapter 2 quiz. So with Chapter 2, oops, I'm going to shut off the recording now, but I hope this has been helpful for you guys.